Things are about to get very interesting in the U.S. economy. We now have at least the early beginnings of a trend that says inflation is up and the job market is weakening. If you understand anything about the quote unquote dual mandate, this is a problem because what you do to fight inflation is the exact opposite of what you do to address a weak job market, aka full employment. Well, folks, we'll go to inflation first because it's PPI day, but we will definitely hit the job market in a minute. PPI came in, frankly, hotter than expected. This cannot be seen as good news by the Fed. Now, the Fed will undoubtedly talk this number away. They will make excuses. They will talk about time of year. They will do all kinds of stuff to make this number that they are not happy with seem inconsequential. But folks, this is potentially the beginning of a trend and the beginning of a problem. So let's go over the numbers. Remember, all inflation reports come out with headline, core being X energy, X food, and they come out year on year, month on month. So 4 numbers we will go through. So let's start with the ugly, the nasty number. Headline inflation last month was 2.4. The expectation from all the experts was inflation would rise to 2.6. Folks, buckle up. It came in at 3%. 3%. Last month, it was 2.4. Now, let's not forget what PPI is. It's not like CPI. CPI, consumer price inflation, is what you and I pay. Man, it is definitely early this morning. I am mumbling my words. Try this again. CPI is what you and I pay at the grocery store. PPI is what the grocery store pays the wholesalers. So again, it's kind of a leading indicator. A rise in PPI does not necessarily mean CPI will go up. Now, how can that happen? Well, there is a chance that margin is eaten by the retail seller. So again, it's not quite a direct or a certainty, but it is an early indication. Now let's talk about month-on-month headline. Last month, 0.2. Expected, 0.2. Actual, no bueno, 0.4. So in essence, headline missed across the board, and not by a little bit. Headline inflation for PPI missed across the board. Now let's go to core. Core last month, 3.1. Was expected to go to 3.2. Came in at, again, no bueno, 3.4. A significant rise in a single month. This is not good. This should be concerning. But because I expect the Fed to want to cut, again, according to the CME Watch tool, it is a 98% chance that the Fed will cut next week. That's crazy. That's crazy. This is all because they've telegraphed it. They don't want to seem like they're, whatever. But come on now. This is what you've been telling us. But we're going to get to the jobs market in a minute because that could be a bigger problem. Now we'll talk about the fourth and final number, core month on month. Last month, core month on month was 0.3. It was expected to come in slightly better at 0.2. Well, of the 4 metrics, this is the one that hit. It did come in at 0.2. A couple of things to note about PPI that I don't think a lot of people will catch. And this is important because this is a leading indicator for CPI. Here we go. 80%, 80. In case you're wondering, that's a lot. 80% of inflation move came from a 3.1% surge in food prices. Food is kind of important. So again, I am not left in a comfortable position thinking about what PPI reported today. Again, I am on record as saying the Fed should pause also saying they won't because they want to do it. But yes, I don't think there's any question that the Fed should pause. Let's do one more thing. I don't know if you know this, but we've talked about it a couple of times. The third and final inflation reading is called PCE, personal consumption expenditure. And PCE is essentially a mathematical formula collecting inputs from CPI, which was reported yesterday, and PPI, which was reported this morning. The experts at the Atlanta Fed Tracker have taken the data from CPI and PPI and estimated, not good, that PCE will go up 0.3% month on month, and PCE will come in at 2.6%. That is 3.3% higher than last month. So CPI went up, PPI went up, and now PCE is going up. And yet the Fed will cut rates. Now, why might they be cutting rates? Well, we got a weekly unemployment report, again, that I told you was very important. This was one that you and I should be watching because last week was kind of a noticeable jump higher. Well, it went higher again. The unemployment rate was expected to only rise from 217 to 220. It actually came in at 242. 242. Now, this is not quite the spike to over 250 that we saw 2 or 3 months ago, but this is a noticeable jump and a jump that is now a trend. This now warrants weekly monitoring. For the longest time, we were kind of, bumping along 220, 210, 220. We are now 242. Again, this could be a blip, but at 3 weeks, a 3-week trend going, up, we should seriously watch this, and we will be watching it together next Thursday and the following Thursday. You know the drill. I wanted to talk about the unemployment market in a little more detail because, again, I have significant concerns about 2025 that I don't think a lot of people are talking about. So I wanted to get it on record. I want to have receipts. I want to be able to point back at this video as another reminder of what I've called, and we'll see if it happens together. In 2025, I do not expect the unemployment rate to climb to extreme levels or climb with extreme speed. I suspect that the unemployment rate, worst case, again, my opinion, worst case, is going to be 4.8%. So again, higher than today, no doubt, but nothing like 5.5% or 6.5% or 7%, which I've seen some people talk about. However, I do think there is a growing and likely misunderstood problem in the jobs market. I believe what more and more people should be talking about is what's called continuing claims. Continuing claims. As a real estate channel, one of the metrics you and I track undoubtedly in our buy box is days on market. How long does something stay available? In the unemployment world, that is called continuing claims. It means you are on the receipt or getting, you're still unemployed week after week after week. So I expect continuing claims to rise meaningfully. Again, think about what I'm saying. I don't think the unemployment rate goes up very high, but if you get unemployed, your tenure, your duration on the unemployment rolls will go up. I do not know what the average is today, but let me give you an example of how bad it might be. If you look at the unemployment duration today, and let's call it again as an example, 8 weeks. You're unemployed 8 weeks. I see it as extremely reasonable that it might double to 16 weeks. Again, folks, I probably have PTSD from 1981, 1982. Again, sometimes you can't run away from your history and your baggage. I get it. I'm biased. It is seemingly so much like the early 80s. It is frightening to me. So again, I'm going to go and try to figure out what the average duration today is on unemployment, because I think by this time next year, so 12 months from today, so, oh, wow, it'd be 12, 12, 25. duration could double. So again, I think that's what the Fed is starting to see in their data. And right now it appears that the Fed is most concerned about the job market. Again, we have inflation going up and the job market weakening. The question is, how severe is inflation? How severe is the weakening? I think this is what the Fed is going to use to cut next week and then probably go on pause for a while. That is just where we are. I do want to congratulate two more amazing people for joining school. I want to congratulate and thank Bill and Denise. Yes, two more school members. Remember, when you joined school, you were getting in a community of roughly 350 amazing investors at all different skill levels. You may just be a total novice and have interest. You may be experienced with one or two or three, and you might have a decent sized portfolio. You might be a flipper. You might be a home builder. You might be buy and hold. You might be short-term rentals, mid-term rentals. Doesn't matter. The community we are building at One Rental at a Time is for all. We already have 5 accountability groups. I am looking for folks to join that would like to do out-of-state investing. I think that would be a great weekly call. And again, an area I have zero experience is in short-term and mid-term rentals. I would love to have a go-giver join and probably partner with one other person so that's dual heads and help create 2 more, masterminds or accountability groups, whatever the 2 of you decide. I think that would round out the accountability groups. Just to talk about an accountability group, Frank did, I think, his 21st or 22nd week in a row. And again, any topic is fair game. They talked about yesterday cannabis dispensaries in a mixed-use commercial building. That ought to be interesting. Can you think about a cannabis store on the bottom and units up top? That could get interesting. How about a comparison of Appfolio, Buildium, and Doorloop? Again, 3 applications I have zero experience with, but because this is an accountability group, others have, and they've started talking about it. And then finally, people are really making plans for the ORET event. They are getting together at different hotels, making plans for the night before and the night after. Let's talk about who should be coming to Vegas, because I think there is a big misunderstanding. Why do newbies need to be there? Folks, newbies need to be there because they need to get in the right rooms. They need to see it's possible. They need to ask questions. They need to see that they are not alone. If I could do anything for a newbie that's getting started and serious, is get your butt to Vegas, get in a room with 300 plus other people doing the work, and just see how the vibe shifts. And of course, introduce yourself, make some friends, and ask lots of questions. Couples, you need to be there together if you can. Again, I'm paying specific attention to couples. We are having one open day 1 and day 2. There are lots of amazing couples that come to these events. Again, network, meet, see that you are not alone. Why do folks with their small portfolios, 1 to 4, right? The people that are in the suck. I have never hidden the fact that the first 5 years suck. The best thing you could do if you are in the suck is get around other people that are in it and other people that have been through it. You need to see that the pain ends, that the surprises end, that you get better. And then finally, if you're a very experienced investor, you've been doing this for decades, it's always nice to get in rooms with other people have done that, to talk with speakers, to network, to share your gift. This is a community of go-givers and people that love to be there. So I hope to see you in Vegas. Tickets are selling faster and faster. So don't miss out. Get the tickets. I think we're like 60 days away. We're basically 2 months away from the event, which is pretty concerning because I have to still buy a lot of stuff. Let's talk about real estate and active inventory. I think active inventory is something that is very important. It gives buyers, you and me, the opportunity to look at lots of stuff. It allows us to find motivated sellers. But did you know, and I think this came from Logan at Housing Wire, so kudos to him, 40% of active inventory growth is from 2 states. So again, we've heard a lot of people point at the rapid growth in active inventory as a sign that a crash is coming. I ask you, if 40% of that active listing growth comes from 2 states, Florida and Texas, is it the earth-shattering warning that some people are making it out to be? Probably not. Read an interesting report from BlackRock. BlackRock is now saying that it is extremely reasonable to allocate a wealthy person's portfolio to have 2% of Bitcoin. This is, if something like this takes off, Michael Saylor's going to be right. That's all I got to say. If you take all the billionaires and 100 millionaires and decamillionaires and you have them allocate 1 or 2% of their portfolios to Bitcoin, it's going to get interesting. Again, this is a decision I personally made in 2018, which I'm extremely happy with. But yes, this is the chasm. And if you don't remember, I had a conversation with a 10-year Wall Street veteran, Taylor from Life Goal Investments, probably a month ago. And I asked him, are his wealthy clients, he works with the 1% of the 1%, are they talking about Bitcoin yet? And the answer is they are starting to talk. They are starting to ask questions. They have yet to make any major moves, but this is just, I think this is just it's like one of those things that's gonna happen. I think there are going to be more folks that are worth a lot more than me that say, you know what, Mr. Money manager, go get me a 1% exposure, a 2% exposure to Bitcoin. And then things get interesting. Folks, we have a Swiss bank just cut interest rates 50 basis points. 85% of their economists thought it would only be a quarter. So the Swiss bank went more aggressive, 50. They are expecting inflation next year to be 0.3%. That's a problem. Let's remember that the Swiss bank, or the Swiss, were the first major bank to cut rates. They cut in March. They were the first mover. They've indicated that more cuts are coming. And most importantly, 0 interest rates are on the table. Said another way, they're going back to 0. And they could be at 0, according to this article, by June. Are we really going to revisit ZERP? I certainly hope not. Don't know if you guys caught this, but the NASDAQ crossed the 20,000 level for the first time. Again, I thought that was interesting. Let's talk about one more thing, and we will close this out. And we'll talk about the CNB survey about holiday shopping. This is a survey they do every year. I'm always interested in seeing what people think. As of right now, 16% of replies thought they would spend more, 1/6. 48 thought they would spend the same. And finally, 36% thought they would spend less. That's what I got for you folks. I hope to see you in Vegas because you've got to be there. Also, join school, be a part of this community, get around people that are really, really doing the work. And of course, have an amazing day. I hope you have a great weekend, and we will talk again Sunday morning for the daily financial news. Take care.